Okay, thank you all so much. I hear some people are not able to access the Mentimeter. We will send the links again, but I could see we have quite a number of people joining us from different parts of Nigeria. Thank you, Chief Emmanuel, Eze Sinachi from Enugu. Muinat, thank you for joining us. Please keep dropping where you're joining us from. Please keep dropping where you're joining us from. Thank you, Dr. Fola, and so many others that have joined us. So now we will quickly move along. We will drop the Mentimeter codes as we'll use that for some of the interactions in the course of the session. So we'll quickly move along now as I invite the CEO of the United Nations Global Compact Network Nigeria to give us her opening and welcome address. I welcome Naomi now.
Thank you, Gloria. Can you see and hear me?
Yes, we can.
Okay. Good morning, our distinguished speakers, participants of the UN Global Compact Network Nigeria, colleagues, and everyone joining us today. You are warmly welcome to the first session of our Corporate Transition Readiness series, beginning with a very timely conversation on the future of sustainable capital, bonds, loans, and transition instruments. We are having this conversation because we see and know that the financing landscape has changed. For many years, businesses could speak about sustainability in broad terms as commitments, goodwill, and corporate responsibility or future ambition. But that era is closing very quickly. I think I can hear noise in the background. Can you still hear me? I think there's noise in the background. Can you hear me now? I think I'll just proceed.
Yes, please, you can go on.
Okay. In this era, capital is asking practical and demanding questions such as, can a company withstand climate, social governance, and market shocks? Does a business, no matter the stage, understand the transition risk facing its sector? Can it show credible data beyond just good intentions? Does it have a strong governance system that asks the right questions? Are its sustainability commitments connected to financial decisions, investment plans, and operational realities? These questions are now pertinent for every business unit, not just our sustainability teams. They are essential for the CEO, the CFO, the board, and risk committees. They are equally vital for those leading strategy, sales, procurement, operations, and human resources. In short, these are the questions for every leader concerned with our competitiveness over the next decade. This shift is critical because sustainable capital is no longer a marginal conversation. Globally, the sustainable debt market has expanded dramatically. According to the Climate Bonds Initiative and the World Bank, the cumulative volume of green, social, and sustainability-linked bonds reached $6.1 trillion by early 2025. Clean energy investment is accelerating at a record pace as well. A Bloomberg NEF report released earlier this year confirmed that global investments in the energy transition hit $2.3 trillion in 2025, driven heavily by electrified transport and renewable power. Yet, while capital grows globally, access remains strikingly uneven. The UNCTAD World Investment Report in 2025 reveals a sobering reality. International project finance, the very lifeblood of large-scale infrastructure and development, recently registered its steepest decline, falling by 26%. This highlights a vital truth, that the challenge we face is not merely the availability of capital, but the readiness of markets, institutions, and businesses to absorb that capital credibly. In emerging markets like ours, these high-level conversations can easily be overshadowed by immediate operational and macroeconomic pressures like high energy costs, infrastructure gaps, currency volatility, and shifting regulations. However, we cannot lose sight of the fact that the massive pool of global and local capital is actively seeking credible transition opportunities across the energy, manufacturing, agriculture, transport, and financial services sectors. The real question has moved beyond if capital exists to if businesses are ready to access it. Because capital does not move simply because a company says it is interested in sustainability. Capital indeed moves when there is confidence, confidence in governance, confidence in the numbers, confidence in the transition plan, confidence that risks are understood, and confidence that proceeds will be used well, and also confidence that the business can deliver both impact and returns. This is one of the major objectives of this series. At the United Nations Global Compact Network Nigeria, we are here to help businesses understand what capital is looking for, what credible transition readiness requires, and what practical steps companies must begin to take now. We want to move from what is a green bond to what makes a company bond ready. From what is a sustainability-linked loan to what internal systems must a company have before it can credibly take one. And from what do investors expect to what should a Nigerian business start doing tomorrow morning. This is the spirit of today's session. We are privileged to be joined by incredible speakers who understand capital from different but deeply connected perspectives: global investment, infrastructure finance, and institutional market development. They will help us unpack not just where the money is, but what the money now demands. My invitation to everyone participating today is simple. Listen with your business in mind. And as the conversation unfolds, ask yourself, what will we need to change in our governance? And what data do we still not have? What risks are we not pricing properly? What opportunities are we not structuring clearly enough? And if an investor asks us today for our transition story, would we be ready? If this session does one job, we should not leave only better informed. We should leave with a clearer sense of what action looks like. On behalf of the UN Global Compact Network Nigeria, I thank our speakers, our moderator, and all our participants for making the time to be part of this important conversation. We look forward to a practical, honest, and forward-thinking dialogue. Thank you, and once again, welcome.
Thank you so much, Naomi. Thank you for, I think you've just given us the right frame for the reason why the conversation matters. So I will not go too deeply into setting the context because Naomi has really given us the reason why we're here. But I just want to point our attention to a couple of statistics and figures. So if you can share the slides, please. Okay. So just like Naomi shared, capital is moving. And if the capital sat across from organization today, if capital was a person, what would it say? Would it say a good ESG story or a finance-ready transition pathway? That is the lens that we want to look at as we go into the panel and discussions today. We see that the market is no longer only asking whether a business has just sustainability commitments, but whether those commitments can survive financial due diligence, credible data, governance, costed projects, measurable targets, and a pathway that lenders or investors can assess. If we go to the next slide, you will see the data before you showing globally what the numbers are looking like. Globally, sustainable capital is moving, as shared by Naomi earlier from the Climate Bonds Initiative reports, 6.8 trillion US dollars in aligned cumulative green, social, and sustainable bonds and debt. We saw that at the end of 2025. The International Energy Agency projects 3.3 trillion USD in global energy investments by 2025, with around 2.2 trillion going into clean energy, grids, so storage, low emission fuels, efficiency, and electrification. Coming to Africa, we also see that the Africa Development Bank is pushing a new financial architecture to mobilize the continent's institutional capital and close a major annual financing gap. It's also investing 125 million in African trade and development insurance to strengthen guarantees and insurance as de-risking tools. And recently, there was a close, they raised recently about over 112 co-financing. So the continent cannot rely only on concessional funding or traditional aid flows. AFDB is showing that as is talking about mobilizing Africa's own institutional capital, pension funds, sovereign wealth, savings, and guarantees to close the major development finance gap, which means that companies must become more investable because if the capital is available, then we need the companies to be able to tap into that. So the conversation that we're having now is happening also in Nigeria at a time where Nigeria is trying to move from climate ambition to climate finance architecture. Data from the Reuters reports on Nigeria's announcement of the 2 billion USD National Climate Change Fund and a 500 million USD climate investment platform. Nigeria also has proof points. The sovereign green bond markets, they raised the first bond in 2017, another in 2019, and more recently, the third one. And now the key issue is how to move from sovereign proof points to stronger private sector pipelines. Even on the carbon market side, we can also see that carbon markets are also becoming part of the conversation. But carbon finance will not reward just ambition. It will require data, baselines, verified data, project integrity, and clear governance. So for companies, the opportunity and question to ask is, can you prove the transition value of what you're doing? If we go to the next slide, we will see that there's one point that is clear, that transition finance is not charity capital. Neither is it soft money for good intentions. But it is also not a reward for saying the right things. It is capital trying to understand risk, future competitiveness, and the commercial logic of change. So when a company talks about transitioning and we talk about transition capital, we ask very practical questions like, what exactly are you transitioning from? What are you transitioning to? What will it cost? Who owns the plan internally? What data proves your starting point? What will change in your operations? What happens if you do not transition? This is important for Nigeria, particularly because we are an emerging market and most of the key sectors, almost everyone uses energy, but most of these sectors, everyone's business is aligned to it. When we talk about energy, when we talk about cement, when we talk about transport, manufacturing, agriculture, logistics, and infrastructure, these sectors cannot become green overnight, but they can become more efficient, more resilient, better governed, and less carbon intensive about their pathway. And that is the opportunity we see that transition capital offers. So concluding this, when companies enter the conversation, next slide, the first question is, sometimes they ask, should we do a green bond? Should we look out for a sustainability linked loan? Can we access transition finance? Can we get blended capital? Those are valid questions, but they're not the starting point. The starting point is, how ready are you as an organization? For use of proceeds for the transition finance, the question is, do you have clear eligible projects that can be ring-fenced? The proceeds, can you report and validate the reports? Do you have credible KPIs that are ambitious, measurable, and linked to real business performance? And do you have a whole company transition plan, not just around energy, but also around people, that is approved by leadership, backed by your CapEx, with milestones that can be verified and tracked? So today, I hope we do not hope to discuss instruments alone. We will discuss what sits behind the instruments, because capital does not only ask, what do you want to raise? Capital also asks, what have you prepared? What evidence do you have? What risks have you identified? What governance is in place? What happens if the assumptions change? And how do we know this is not just a nice story? So this session is going to be a practical session, practical conversation. I see some questions already in the chat, so we would hear from the experts. And then after the experts are done, whilst they are speaking, if you have any questions, please use the Q&A button to drop your questions, and we will try to get to as many questions as possible in the course of the session. So now to introduce our amazing speakers, the voices who understand capital from different angles. We were very, very glad to have, very, very diverse experiences join us for this conversation from different angles across global investment, infrastructure, finance, institutional market development, and they will help us unpack these topics very, very clearly. So before we bring in the speakers, I hope we were able to get to answer the Mentimeter questions. We will try to show the responses Q&A box so that people can access. Now, moving on to calling the speakers, I would like to introduce the first speaker, Samuel Mary from Pacific Investment Management Company, also called PIMCO, which is a global investment management firm. Mr. Mary is a senior vice president and ESG research analyst in the London office, focused on the integration of ESG factors into PIMCO's portfolio management and credit research. He also leads PIMCO's research on climate change. Prior to joining PIMCO in 2018, he worked as a senior ESG and sustainability research analyst at Kepler Chevreux, pronounced as Chevreux. I hope I got that right, where he was responsible for the group's thematic and impact investing research products, ESG corporate access, and in-house ESG integration framework based on methodologies that integrate ESG issues within fundamentals of equity analysis for specific sectors. He has 12 years of investment experience and holds a master's degree in management with a specialization in finance from ESCP Europe. He was Extel's top-ranked individual for SRI research in 2017, based on surveys of UK asset managers. Samuel brings the global investor perspective into this conversation as PIMCO works across international markets. So his perspective will help us understand how global investors are thinking about sustainable finance, transaction risk, emerging markets, and what makes an issuer credible. Welcome, Samuel. We're so happy to have you join us. Next, we will be introducing Daniel Muela, who is the Executive Director and Chief Operating Officer at InfraCredit Guarantee. Daniel Muela is a versatile corporate finance professional with over 20 years of experience in transition, structuring, credit evaluation, project finance, due diligence, operations, project management, and capital raising. He joined the company in 2017 as one of its pioneering staff, acting as the head origination and structuring before being named the COO in 2021 and appointed executive director in 2024. He started his career at JP Morgan's investment banking division in 2000 and served as a United States Peace Corps volunteer in Togo from 2004 to 2007, then spent over 9 years in Nigeria with Deloitte, Touche, and Global Emerging Markets before joining InfraCredit. Daniel Muela holds a BSc in Economics, Finance, Public Policy from the Wharton School at the University of Pennsylvania and has passed all levels of the CFA examination. Daniel brings the local market and credit enhancement perspective as InfraCredit's work is important because many Nigerian companies and infrastructure projects may have strong potential, but they still need the right structure, documentation, risk profile, and credibility to access long-term capital. And InfraCredit Guarantee has been pioneering that work on the continent. So we're so pleased to have you join us. Welcome, Daniel, to the conversation. And next, we also have Abraham Durosawe, who is the Vice President of the Nigeria Sovereign Investment Authority. Abraham Durosawo is a seasoned institutional investor and executive with a distinguished career spanning private equity, investment banking, and large-scale infrastructure finance. He currently serves as the Vice President at the Nigeria Sovereign Investment Authority that manages the sovereign wealth fund of the country, where he leads the industrialization thematic under the Nigeria Infrastructure Fund, driving strategic capital-intensive investments designed to capitalize sustainable economic growth and localized value addition. Prior to joining the Sovereign Wealth Fund, Abraham was the managing director and CEO of the ARM Capital Limited, the advisory and capital markets subsidiary of ARM Holding Company. He's a specialist in structuring complex transactions. He has successfully shared landmark debt and equity capital raises, orchestrated high-value mergers and acquisitions, and negotiated definitive frameworks for critical national infrastructure and energy projects. Abraham brings a wealth of expertise in aligning institutional capital with sustainable systemic market development and brings the domestic institutional investor perspective to the conversation. NSI sits at a unique position because it's not only investing for long-term value, it also signals to the wider market what credible future-facing investments can look like in Nigeria. So welcome, Abraham, and I would like you all to give a warm applause to our panelists as we go into the question. If they can just unmute and probably just say a word, maybe just, we just want to hear their voices.
Thank you.
Okay. All right. Okay, then. So I want us to move now into the heart of the discussion. We know that sustainable and transitional capital is growing globally. We hear a lot about green bonds, sustainability-linked loans or guarantees or blended finance instruments and climate capital, but not every company or market is able to access this finance. From where you sit, where do you think capital is actually moving, and what kinds of companies or projects do you think will be able to attract this capital? Maybe I could start with Samuel, and then we go to Daniel, and then Abraham.
Hello, everyone, and thank you very much for having me today. It's a real pleasure to participate in this webinar. Um, Building on the introductory remarks and the figures that have been shared on the sustainable bond market, I'd like to start by highlighting that this is a robust and mature market that has grown significantly over more than a decade to exceed $7 trillion across different instrument types. So the market has increasingly diversified. Green bonds remain the most significant instrument, but there are also social sustainability, linked, and transition bonds that have emerged and offered a broader range of instruments and opportunities for issuers that wish to embrace sustainable financing tools. In terms of your question regarding where the capital is actually moving and concentrating, it's generally speaking focused on the credible green infrastructure, whether through direct exposure, such as through utilities, through renewable energy projects, or through real estate via, for example, green buildings or energy efficiency related projects. And also indirectly through banks or multilateral development banks that are lending to these different low carbon sectors. In terms of the issuer types, so the market was initially largely driven by supranational issuers, as well as corporates associated with the sectors I have just mentioned. And interestingly, as it developed, we have seen this broadening trend that I've mentioned with instruments also apply to different asset classes and sectors, so including a broader range of corporate sectors, including also sovereign, including more SSAs, and also in the structured product space. As it relates to the regions, geographically, Europe and APAC continue to dominate, supported by robust regulatory frameworks and a structural buy-side demand. But I think for the purpose of today's discussion, it's interesting to underscore that the frontier is shifting, meaning in practice that there are more regions, more issuers that are participating in this market or taking measures, steps to be in a position to issue label bonds in the future. And that's driven by a few trends very quickly. I mean, number one is the financing need for the energy transition, climate resilience, and more broadly to strengthen issuers' operational resilience and their ability to manage material sustainability risk. Number two, the momentum for transition finance is notable. So that means in practice, high emitting sectors and the sort of buy side and investors' appetite to support real economy decarbonization in these different industries that have been underrepresented in the label bond market. And also the growing interest in emerging markets, which is particularly relevant for today, and the awareness of the fact that the financing needs are particularly large, and also the opportunities to make a real economy sort of contribution by impact-driven asset owners is also supporting this general interest in these regions. And I will also maybe finish by emphasizing the importance of the inclusiveness of the label bond market. So that means in practice there are more resources that have been made available to support transition finance. For example, at PIMCO, we have been very active across a number of industry initiatives, being through the ICMA and its development of the transition bond guidelines, also through an energy-focused initiative which is dedicated to supporting methane abatement finance for oil and gas companies, and which is a powerful illustration of the investors' strong interest in having these high-emitting industries, challenging sectors, incentivized to invest into real economy decarbonization through credible structures, and there are more guidance to help them in this respect.
Thank you so much, Samuel, for sharing that and the context and some of the opportunities that we see currently in the emerging markets and some of the things that are also happening even in some of the other regions. I'd love to go now to Daniel to share his perspective also to the question on where you think capital is moving, also with your experience around the guarantees.
All right, thank you. And it's a pleasure to be with you today. From a general standpoint, and let me make sure everyone can hear me. I hope everyone can hear me fine. From a general standpoint, Nigerian pension funds being the largest domestic institutional investors, what we're seeing in Nigeria is a steadily increasing risk appetite. So, as opposed to just investing in federal government treasuries, federal treasury bonds, they are investing on the back of our guarantees that InfraCredit issues on behalf of corporate issuers. So that's opening up new financing opportunities for clients to issue long tenured bonds, 10, 15, 20 years, really pushing out what's possible for corporate borrowers. Pension funds are also investing in a wave of infrastructure funds in Nigeria as another way of diversifying their capital. So that's giving, again, well-organized corporate borrowers a lot more opportunity to go outside of the banking sector and borrow much longer term and access more patient capital in terms of debt finance. And when you obtain the right type of debt finance at the right interest rate, it actually makes your story more attractive to equity investors as well. If you're an equity investor, you don't want to invest in a company that's borrowing at 30% interest. You'd much rather invest in a company borrowing at 18% interest. Now, in terms of global capital and sustainable capital, we are seeing international development finance institutions that want to invest in projects that involve energy access, like solar mini grids, green housing, basically EDGE certified housing and the like, climate smart agriculture, basically reducing the post-harvest losses and really enabling food to actually get to market, and water access, anything that's really socially impactful. They want to bring that capital in. Now, we've known this for years. What has changed in the last, I'd say, 4 years is a willingness of these DFIs to actually bring that as a local currency instrument. So for a while, they were bringing maybe low interest rate dollar debt, but that still posed a risk to the local operating companies if they're earning Naira and they have to repay even cheap US dollar debt becomes very expensive if the Naira devalues, because you still have to find those dollars and repay that original dollar debt principal. But what we've worked with, we're working with several DFIs that are actually pairing the Naira debt that we guarantee with a local currency debt instrument of similar tenor, again, at favorable interest rates. And so that's been a good change for the market, is a willingness to put local currency matching debt, even though they're bringing foreign money into these projects. So again, these are the trends, and it's very positive. And the capital is really available. It's really our collective job to help the clients to be well organized enough to actually access that capital. That's the other challenge. And I know we'll get to that as part of the questions today. Thank you.
Thank you so much, Daniel. It's always sweet news to hear that money is available, and even more so, one of the risks, the macroeconomic risk, which is FX, hedging FX, to just see that InfraCredit is leading that conversation and doing so well on the continent. So to the viewers, there are opportunities, and we will go into the conversation and learn more about how to position yourselves. So I'd love to hear now from Abraham your thoughts on the question on where you think capital is flowing.
Thank you very much. And thanks, Daniel. Daniel and I come from the same world. So I'll just piggyback on what he said. I think overall, speaking to what Naomi mentioned in our earlier speech, I think one of the biggest headache we have are really investable opportunities. And I think that is one thing most business people need to realize, that that is the portion of the work they need to do that an investor cannot do for you, because he is on the other side of the table. He has an investment committee to present the opportunities to. It is then left for those on the other side to structure themselves correctly and appropriately. And thankfully, we have instruments like the infra credit that further enhance businesses within the ecosystem to be able to access this capital. Is there money in this economy? Absolutely. And if you check, firstly, if you look at the FDI numbers, came out some 2 days ago, Nigeria is significantly attracting tens of billions of dollars. Of course, there will be arguments that most of it are FPIs, meaning the hot money, but there's some component which is FDI, which is growing, right? So meaning that Nigeria is progressively an attractive space for investment. And I'll explain what is driving this attraction. One is a global geopolitical situation, right? And if you take case in point, Dangote and the whole energy security conversation, they are now having to think about expanding their plants and also extending to other African countries, because now you see, once there's a major problem in other parts of the world, you might end up being a recipient of the effect. And you can see what has happened in terms of energy prices for doing nothing and for not being part of the table when the issues are coming up. Now we are over 50% cost of energy in the last couple of months, right? So even from an energy security point of view for the country and the continent, there's a lot of thinking now about domesticating these businesses in such a way that it provides assurance for us as a nation and also for the continent. And this is something that also aligns with NSIA's strategic intent around industrialization locally. And what comes with that is you retain jobs, and that has a ripple effect on the economy. So I think that global geopolitical issues and challenges are driving certain countries to become more economically viable. And then I think, secondly, you need to realize that Nigeria is a blessed country from a resource point of view. And that is one of the resources that we are trying to translate for the Nigerian economy is in the agri space. We are currently conceptualizing and working on a project alongside the Moroccan government to build an ammonia plant, 1.5 million metric ton in Nigeria, so that feeds the fertilizer industry and that gives assurance of food security, rather than the days of where we have to import all the raw materials. One of the most commonly used fertilizer in our climate is NPK fertilizer. Today, we have some sufficiency around N, that's nitrogen. Most of the plants you have in Nigeria, they are urea plants, from Dangote to Notori to Indorama. P, we do not produce. Our own plant is designed to be the first in Nigeria, if not in West Africa. And then K, we don't have, we import. So you see that from a food security point of view, there has to be strategic investment in all this value chain, so that one, it drives our own economy, two, it creates jobs, and then we have an assurance of the future. So if you think about it from an opportunity point of view, Nigeria is a good place to invest. So that's explain why the capital is flowing. And you can see the excitement around the Dangote IPO that is coming. Most of the African countries are flying in to say we want to participate. So just to tell you that they are seeing the market, they are seeing the opportunity, they are seeing that if there's a clear doer on ground, capital is willing to flow. And that is one thing I want all the businesses around the table to take away. And then secondly, speaking to what Daniel spoke about, we try to enable local capital so that you take away the issue of currency devaluation, which Nigeria has experienced over the last 20 years. Very worse over the last 10 years, right? And so why an institution like InfraCredit, which NSIA was instrumental with setting up, is very critical. What will make the local pool of capital comfortable to invest? They want assurance, and that is why what InfraCredit provides, so that on the back of the wrap that InfraCredit provides, they are able to secure investment grade rating. Before you can raise money from the pension industry, you need investment grade rating from 2 rating agencies. Most businesses cannot secure that rating, and why institutions like InfraCredit become very important. So I think, again, I want to thank the UN Global Compact Nigeria, because conversations like this are very critical so that businesses around the table understand that, yes, there is this money. However, they have certain criteria before that money comes out, and they can take advantage of instruments available in the market to prepare themselves to access those capital.
Thank you, Abraham. I think you've just segued us into the next question, which was kind of around what we see as the way to go for the companies, like you've mentioned, what's beyond ambition. So yes, we see that a lot of companies are interested, and even from some of the questions on the chat as well, people want to, decarbonization, net zero, but the practical steps with what InfraCredit is doing, and some of the localization also of the instruments, and also from, even from the global perspective, like Samuel shared. So the next question I have for you all is, when a company says that it wants to access capital, let's say this capital exists, like you've mentioned, what does it really need to do practically beyond ambition from where it stands? And do you think that this market is open to, because we did mention a couple of sectors, we've mentioned like the agri sectors, those in fertilizers. Do you think this is open to all the sectors of, all the businesses? Yes, and anyone can just jump at it.
Okay, maybe I should take the first stab. Well, I think if you look at an investor, firstly, I will encourage businesses around the table to check guidelines around investment in Nigeria. Most of these documents are online. To the pension industry, they have the PRA, the Pension Reform Act, that prescribes how they're able to invest and what they're able to invest in, right? So that will give a good guideline to see what are and the pension industry is the biggest pool of long-term capital in Nigeria. Now, I think over 29 trillion. And because there are, most times they can't find where to invest, they put most of it in government securities. So I think that guideline is a good place to start to see what are the kind of industries they're interested in. So at the NSI, we invest across sectors from health to agri to sustainable farming to energy, across board, right? So I think what most businesses need to ask themselves, are you in the right sector? And is the sector attractive? Are there significant opportunities in that space? And, I use Dangote again as an example. What he has essentially capitalized is to find a specific area where he has helped the country to reverse dependence on imports. And we can see the impact that has on our currency stability. So yeah, I think it is basically looking at all the different opportunities. Now, from our own view, what are core priority sectors? And I see some of the comments on the chat box. Energy is critical. And one of the things we have seen very recently is the fact that, whether you like it or not, Nigeria is progressively moving towards decentralized, renewable source of energy, particularly for residential users, right? So the opportunity in that space will continue to grow. So if you look at the housing space, everybody needs somewhere to put their heads, right? You can see what's happening in Lagos in terms of inflation in rental fees and across the country. And that is driven by inflation in the demand for building materials. And one of the key drivers of that is the fact that the government started to use cement for building highways, right? So now we're having concrete roads. So you see, there are opportunities across these various sectors, particularly in energy, and especially in renewable energy. NSIA particularly, we produce some of the solar panels locally. We are looking at glass manufacturing projects because you need glass as one of the inputs for making solar panels. So from a domesticating the production point of view, that is an area we look at. So I think essentially you just need to look across the value chain, because I know people on this call are in different sectors. Study the statistics, look at the demand, look at the direction of the economy, pay attention to government policies, and that gives you an indication of the opportunity that that is in front of you. And I'll give a practical example. And I believe we all saw in the news that the presidency has gone off grid, it gives you a signal of the kind of opportunity that exists in that space. I'll stop there.
Thank you, Abraham. So, Daniel or Samuel, you want to chime in to add your thoughts on the question on what companies need to do beyond ambition or intention?
Okay, happy to take a stab at it. Thank you. And again, so there's different companies out there, right? There are those with great track record and who've been borrowing and really aren't in need of a lot of advisory and assistance. And then there are a lot of people just trying to kind of start out. And so they have great ideas, but maybe they've never borrowed before. So I'm not always sure which audience we're speaking to, but for a lot of companies in Nigeria, for a lot of people trying to do projects, whether it's a water project or a solar project, they've never actually owned and operated that type of asset before. They've planned it, they've done their research, their studies look fine, but they have not actually earned revenue from selling solar power or doing water services or running an agro manufacturing plant. And so the hurdle is so much higher to prove that you actually have the capability. It's not just what's in the book, right? So it helps if you've worked in the industry. It helps if you've been at least an EPC contractor. If you've at least built this thing for someone else, then we know that that's not a risk we have to worry about. You can actually do it at a lower cost than if you had to outsource the EPC to somebody else. And the other piece is, again, there are also another class of companies who've only done EPC. They've never actually owned and operated. And so, yes, we know you can build it, but we still need to know if you can actually serve the end customers. And I use the power sector a lot of times. People talk about, cost reflective tariffs and AT&C losses and all of these things. And really, it's just, do you have happy end customers? If you have happy end customers, then they're going to sing your praises, right? So I'm not worried about whether a customer will pay their electricity bill. I'm worried about whether you will give them, 23.5 hours of light so that they're happy and don't have to worry about it anymore. Because if they have to resort to their generator, if they have to resort to their borehole for water pumping and all these things, they have to go back to living a DIY life. They're not going to want to pay you the premium that you need to earn to make your business successful. So that customer service side, again, it may be hard to prove in the particular industry where you're trying to do your project, but maybe you've done it for someone else. Maybe you've been doing EPC work and you've been doing consultancy work, and we can still speak to your clients as part of the due diligence and see that, oh, you're the type of promoters that actually have a client-centric focus, right? You make sure that the job gets done. So that's around the project, knowing that you're the right, because we could back anybody. Nigeria has 300 million people or whatever we are today. It could be 240 million, but we have a lot of ambitious people. with similar project ideas. So how do you differentiate yourself from somebody else? It has to be in the doing, as Abraham mentioned. When we really support those who have track record, have found ways to demonstrate it. And another piece of that is just proof of concept. You might want to do a 10 megawatt project, but the amount of equity you need and debt you need is beyond where you are today. But that doesn't mean you can't do something. So maybe you do a 10 kilowatt project. At least you've done a project. You put it on your own house. You put it in your own office. You've shown that that actually demonstrates a level of seriousness. So it's not always about the global EPC contractor, the global equipment supplier. No, all of that we can fit together. You being able to deliver the service, whether it's electricity, water, whatever it is, you being able to deliver it and satisfy end customers, that's really what we're trying to assess in terms of proof beyond ambition. So I'll stop there. Thank you.
Thank you very much, Daniel. I have a follow-on, but I will just let Samuel give his thoughts on it, and I would share the next question. Please drop your questions on using the Q&A button. I think some of the questions have already been answered by the panelists, so we may not read through them, but please continue to drop the questions. So Samuel, from where you sit at PIMCO and the wide array even across the emerging markets, what are your thoughts on this, on the question on how companies can move beyond ambition?
Sure. Number one, regarding your related question about which sectors are in a position to seize this opportunity. From a global asset manager's perspective, the short answer is all of them, meaning that there is pool of capital available to support all the industries that are at various stages in terms of sustainability characteristics, transition profile. The sustainable bond instruments that are available can cater to the different situations and characteristics. So historically, the market was dominated by use of proceeds bonds, meaning that issuers needed to have sustainable eligible expenses, such as green capex, typically. But with the development of sustainability-linked bonds, essentially issuers can utilize an instrument where there is no attachment, no association with the capex. So very quickly, the sustainability-linked bond instrument implies that there is a change in the financing condition, typically a coupon step up, if an issuer doesn't meet a sustainability target. So that means in practice that sectors that had lower green capex, including some of the hard to abate, high emitting industries, can utilize this instrument if they are not able to issue a use of proceeds instrument such as a green bond. So that's the first important point. And then related to what companies need to demonstrate in terms of ambition, I would like to give a bit of context regarding our framework that might be helpful to this audience. So we have a systematic firm-wide ESG evaluation of all issuers across asset classes, meaning in practice that we assess their exposure to sustainability risk and their strategy to manage this risk based on this proprietary ESG rating that is industry specific, that assesses not only where issuers stand, but also their trajectory. So there is a forward-looking element, which is important, for example, for utilities that may have a high carbon intensity as of now, but may have a sound transition plan to move towards low carbon sources of energy, such as renewable energy. In addition to that, we also have a label bond framework where we assess the ESG characteristics of label bonds and their quality, and we score them in the same way as we do at issuer level, based on 3 elements. The first one is the analysis of the extent to which the sustainability objectives of the bond is aligned with the broader strategy of the issuer, so that the bond is seen as a tool to support, advance this broader strategy. The second is for the evidence of net positive sustainability outcomes of the projects that are being funded. So whether there is a sort of impact evidence in support of it. And then the third one is the assessment of the transparency of the issuer. So whether the reporting is aligned with recognized international guidance and frameworks, such as the International Capital Market Association impact reporting guidance and the corresponding principle, and whether there are also any controversies and how these controversies are being addressed. So the implication for issuers is that what's key is not only to get a credible, robust label and framework, but also have this connection with the firm-wide sustainability strategy and transition plan, which is the first criterion I have mentioned. That means in practice that the credibility, and that was mentioned in the introduction, but what is important is to get the sort of sustainability strategy in place to start with before developing the sustainable bond framework. That should be seen again as a way of advancing this broader sustainability strategy, and essentially in terms of demonstration also what's a good practice, and we have on our website a public label bond best practice guidance that I will recommend this audience to take a look at for further details. But it also involves, to the extent possible, have some pre-issuance allocation and impact report being made available, so that can help with our assessment, and prior to the financing decision, have all the elements in place, and then post-issuance provide the corresponding allocation and impact report or post-issuance sustainability-linked bond target report, so that across the life cycle of the bond, as an investor, we will have all the elements to make an informed decision, and also to provide feedback and support issuers as needed.
Thank you. So you can all see for the businesses here that there is wide array of resources available. If you're asking what you need to do, where you need to start from, like Abraham mentioned, even going to some of the pension administrator, the websites, or even InfraCredits, they have some of these guidelines. So all you need to do is just go and look and see for your business, for where you stand, what are the things that you need to start putting in place so that you are on track to be able to access this sort of capital. And it's also being mentioned about proof of concept, track history, and all that. Those are very, very important. So I have one other question for the panelists as well. And please feel free to drop your questions. Like I said, some of the questions have been answered, so I've just put them as answered, so we don't need to read through them again. But I have a question for the panelists, which is kind of what they think, maybe some of the things what you've seen practically in your experience that is happening right now in Nigeria, and what you think, or in the emerging markets, in the next 2 to 3 years, the sustainable capital, sustainable finance market will look like. I know there's also, the carbon markets, which is in the mix. Maybe you also want to share. I know a lot of people are, their interest here and there. Maybe you want to share what it is that it looks like in the next 3 to 5 years for businesses. And we could start from Daniel this time.
Thank you. And I actually think that the bar for accessing the capital will be getting higher and higher. I actually think that a number of companies are sort of benefiting from initiatives like the DARES World Bank initiative that's supporting solar mini grid access. So if 30 different companies are benefiting from that, and then they want to all grow at the same time and scale and do more of it, there may not be enough to fund all of them to the scale they all want to go. So I actually think that the bar will be getting higher. Now that means companies need to be even better organized, and I'll just hit on some of these points. The typical sort of private company operating almost anywhere, their financials are usually older, right? They haven't completed their latest audit. They haven't filed it with the Corporate Affairs Commission. Maybe they're not using a top auditor. They're using a third-tier auditor. Maybe they don't have any independent director. So these are all the things that we help clients do to shape themselves to be ready to access sustainable capital and long-term debt finance. Make sure they appoint independent directors. Make sure that their board committees function. Make sure that they're all PENCOM compliant. If you haven't paid your pensions up to date, no pension fund's going to buy your debt, even with an InfraCredit guarantee. So those are things we're already helping clients with. And it's an acceptable bar to know that, okay, we're going to help you, we're going to guide you. On the project side, maybe you haven't done your EIA yet, but we can guide you that, hey, you're going to need to have that before we can bring you to the financing community. But 2 or 3 years from now, those may just be things that we say, well, you haven't done your EIA, I can't help you. You have not, you're not using a tier 1 or tier 2 auditor. I'm not going to be able to help. So the standards may be rising as more and more companies become more sophisticated and able to access these funds directly without necessarily needing the guidance of an NSIA or an InfraCredit. So it's just how it's going to evolve. The other piece I would say is the first wave of companies accessing this capital. We all have an interest in making sure that the impact story is solid. If capital comes in and we aren't finishing the projects, we aren't able to articulate how many people were connected to electricity, how many people got access to water, then there's not going to be follow-on investment to support our financing environment. So these are some of the things that we all have an interest in making sure succeed so that we can attract more capital. Thank you.
Thank you. Sorry, just and maybe I will also ask this. From where you sit, do you think the companies that you've come across, do you think they're more prepared? And maybe you want to, there's so many requirements that you've shared already around governance and documentation. Which one do you think stands out the most from your experience? And this can also go to all the other speakers as you share. But maybe Daniel, you could just add that.
Okay. I mean, I would say there's a growing interest in accessing sustainable capital, growing interest in borrowing from the Nigerian debt capital market as opposed to commercial banks being the default source of debt. But I wouldn't necessarily say that most companies are more ready than they were 4 or 5 years ago. So we still are guiding them through. I mean, even on our onboarding documents, at the top of the first page of our checklist is your pension compliance number, because we're trying to set from day one that if you're not paying pensions up to date, that probably means your taxes aren't up to date. That probably means your financial filings aren't up to date. And it's going to be a much longer road for you to get compliant and demonstrate that you have a compliance culture, because you can't go to the debt capital market, file with the Securities and Exchange Commission, go get a credit rating from one of the major rating agencies. It's just not going to go well unless you establish from day one that you're compliant, that your corporate governance is up to par. Now I will say there are more companies accessing commercial paper, so that's a good sign that there is a wave of companies going out issuing commercial paper. To do that, they have to go get a credit rating. They have to file with FMDQ or the main debt exchange here. So that is a good sign, because those same companies are then already readying themselves to go and issue longer tenured debt. But I wouldn't say it's a huge wave, right? If I look at the CP market, as much as it's growing, it's maybe 8 companies that stand out and say, okay, those are guys that are already moving on the line. A lot of the projects that still come to us, we have to give them a lot of guidance. So thank you.
Thank you for sharing. Samuel, you want to share your thoughts before Abraham?
Sure. I think in general, so looking at the prospects and the outlook for sustainable bonds in general and in Africa in particular, and including in Nigeria, the well-developed markets dominate, as I mentioned in my preliminary remarks. There is actually a positive momentum for Africa overall, and many countries. there have been some encouraging developments and signals regarding this path. And you mentioned in the introduction the sovereign label bond issuances. There are many sort of initiatives that we are seeing that could catalyze additional market activities. At the level of multilateral development banks and DFIs, there are a number of platforms and products that have been designed to specifically attract institutional investors on commercial terms. We at PIMCO have been directly involved in helping building this bridge. So that includes through the World Bank's Private Sector Investment Lab, which has helped shape the bank's expanded guarantees program. That includes also through certain securitization sort of market innovation that have taken place, also to allow asset managers to participate in emerging markets activities. That includes the GISD Alliance, where we have co-led the new blended finance work stream, and also the UNGC CFO coalition, which is closely connected to this discussion, but has published a CFO guide for sustainable bonds that demonstrates the strong buy-side investor demand and benefits for investors and issuers associated with sustainable bonds. And what this means for Nigerian issuers specifically is that some of the gaps and opportunities in practice to move in this direction tend to be related to, I think, some comments that were previously made about the sort of governance and disclosure and the establishment of a strategy with accountability, the supply of data that are aligned with recognized international frameworks. What I would like to point out here is that it doesn't have to be comprehensive from day one. What matters is the direction of travel, and that on a best effort basis, issuers are moving in this direction and providing some of these important figures to illustrate and the actual sustainability initiatives and the extent to which they are being supported by the company's business plan and financial strategy. And there are also more opportunities of engagement with investors, with institutional investors that can provide feedback to issuers that are interested in moving in this direction. So these are all, I think, indications of the room for optimism as it relates to the development, the additional development of sustainable finance in Nigeria and more broadly in Africa.
Thank you, Samuel. Abraham.
Okay, thank you. Maybe I should just take a stab at the questions on the chat box. I know somebody's asking, how does government balance the priorities? I think you will see what the government has been doing, particularly in the last 3 years. One, you see the PCNG initiative. You see both trucks, almost all the trucks you see on the road now are now gas-fired. So that is a clear diesel displacement. So you see there's a transition towards reducing carbon emission. And then you see the direction of electric mobility. If you go to Lagos now, you have options of taking electric cars, right? And even from government point of view, if you're in Abuja, you can take an electric bus from the airport into town, and these are government initiatives. So just to tell you that, yes, government is progressively mixing carbon reducing strategy into all their policies and even in terms of the action. And progressively, you see that reflected in the budget. And then speaking about, do you want an appointment with NSI infra credits? I think that's easy. Just go on our website to send an email. But I think to Daniel's point earlier, there are over, based on the last statistics I remember, there are over 40 million businesses in Nigeria. How much meetings can we take? So, and that's just a reality. And going to what Daniel said, you need to structure your business. And it is not about even raising capital, it's about designing governance, designing reporting framework, designing structured process and policies and procedures to assure you of your own sustainability. So it's not even talking to investor that is driving it. It is your own habit within your own institution from a sustainability point of view. Now, if you have done that, it makes the conversation very easy. So if I'm going to ask around the table, how many of you have your 5-year audited financial statement right now, including full year 2025? How many can produce a Q1 management account? You know, these are disciplines within the company that you don't need an investor to point you at, right? So not because you can't have as many meetings as possible, but it makes the conversation sweet when you come ready. And that's why you see the investors always have minimal bandwidth of how many people they can talk to or meet with, right? So that would be my counsel, like Daniel said, because when we are doing, even the rating agencies, they will look at the concentration of your shareholders. Are you the only one that owns it 100%? It means that you're going to run with our money, right? So that is something you need to do within your company. Do you, who are the people preparing your accounts? Like Daniel said, if it is not the big four most times, we get a bit more skeptical, right? Because we start asking if it is Abraham and co. How sure am I that you have not bullied Abraham to help you write the numbers? And just to shock you, when we do our own financial analysis, we will know you are lying, right? So these are things you need to take back into, go and check your governance, your shareholding. Do you have a board? Do you meet every quarter? You know, Nigeria has a code of corporate governance. If I ask you for the minutes of all your board meetings in the last 3 years, can you produce it? These are the foundational building blocks. So, and you see, it's not about financing. Sustainability is embedded in your practices. So when you come to NSI, it's not even just we are looking at you, ESG and ranking and doing our checklist and all and due diligence. We review our own commitments as an institution every time. I heard today the World, is it tomorrow is World Earth Day? Is that correct?
Tomorrow, World
Yes,
Environment
tomorrow.
Day.
So they've sent us
Tomorrow.
emails today. There are things we need to do to align with World Health Day. So you see, and just to also let you know, some of the partners we work with, I remember one of the institutions, they did due diligence on us for 3 years. So you see, it doesn't only apply to you trying to raise money from a financier. Even the investors themselves are subject to a lot of scrutiny in terms of ESG compliance. You know, I was with the DFI yesterday. We already see changes that we need to make to align with certain global standards, which is always evolving. So what I want you to take back today is that behavioral restructuring within the entity, not just about capital raising, but from your own sustainability point of view.
Thank you very much. I was about to say final thoughts, but I think that that can serve as your wrap up because we're almost at the top of the hour. So I'll just get like final thoughts from Daniel and also from Samuel, maybe more practical now. I think Abraham has started the train. So one advice you have for the businesses, what you think they should go home and do maybe within the next 90 days, 120 days. And just to add that the United Nations Global Compact, this is what we do, helping businesses with that ESG governance structure. So if you want to learn more, please visit our website. We're always happy to have more companies join us. So I'd like to hear the final thoughts from Daniel and Samuel before we wrap up.
Okay. For me, even we had to figure out how to tell our impact story. So when we started in 2017, we weren't really working with global DFIs. We didn't know what was all out there. So we, over time, had to appoint our, a head of development impact, our head of ESG, bring all of that in-house and really tell our story, so that even our own documentation with clients is saying how many jobs created, how many customers you've added. all of that puts you in a much better position to attract the sustainable capital, patient capital. Also, as far as general borrowing and access to capital, resiliency is tremendously important. You're going to face challenges in your business the same way we face challenges in our daily lives. Your ability to show that you have faced them and overcome them. And again, so a client who has gone out and borrowed at 35% interest to get a project done is actually more attractive than a client who is sitting there saying, well, I had a cost overrun and I need help. Help me, please. That ability to stay to the task, because we know what it means if you're getting the project done despite the odds. It means that you'll continue to do that going forward. When you have, an exemption, you're not supposed to pay duties on certain equipment coming through the port, but then they're insisting that you do. And you have to come up with that extra money to pay it and get that equipment to site, because the project cannot be delayed, because it just becomes a ripple effect, and other contractors get delayed, and you can't hold anybody accountable to timelines. So that resiliency story is also tremendously important. Thank you.
Thank you. Thank you very much, Daniel. Very important in this fragile markets. Okay, Samuel?
I probably will emphasize the importance of articulating the sustainability strategy within the context of the firm-wide business strategy and investment plan. So identify the extent to which the sustainability factors can support the business strategy, enhance it, manage some of the associated risk, and have a clear alignment, consistency within the two, and embed, where appropriate, the sustainability references within the business communication, so that when investors are looking at the business profile, at the business strategy, then it is evident from the start that there is an adequate, robust sustainability approach. And that includes also a related point, which is embedding the sustainability strategy at board level and at the top management level, so that there is accountability, oversight, strategic direction in terms of sustainability coming from the top, and that helps essentially provide the right signal to investors that this is taken seriously and again embedded into the existing structures. And then the potential quick win for issuers is to also, in addition to what I've already mentioned regarding the build out of the disclosure in support of the sustainability strategy, is to look at the recognized international frameworks, so TCFD, ISSB, at issuer level, at bond level, ICMA principles, and start identifying the degree of alignment and the opportunities to increase this alignment where possible, so that in due course issuers will be ready to provide a robust, in-depth sustainability disclosure and elements that can demonstrate to investors the degree of commitment and readiness to the sustainable finance market.
Thank you all so much. And I think that wraps up this wonderful session. Just, summarizing all that they've said, what you need to do as a company, maybe it might be reviewing your ESG emission strategy, speaking with your board, going to check your documentation, like Abraham mentioned, or even like building your track record, ensuring you have that right. And some of all that Samuel has shared around looking at the sustainability standards, reporting standards, ISSB, GRI, what is pertinent, what is important, ensuring that you draft this in your business operations. And it's not just the job for your sustainability team, it's something that should be embedded in the culture, like Abraham shared around behavioral practices. So whether it's the sales team, the marketing team, human resource, everyone must be on this journey of ESG if you want to be transition ready and also open yourself up to the opportunities As we close, let me briefly share that this session is just one of many series that will continue. We'll continue to have many more series on corporate transition readiness. Please, a lot of you asked about how you can get ready for this. We have a pool of resources available on our website. Please visit our website, United Nations Global Compact Network Nigeria, and we are always happy to welcome more companies to join the compact, as this is what we help them do. We want to really, really thank our speakers, Daniel, Samuel, and Abraham. Thank you for your very, very, very insightful comments, suggestions, and all the practical thoughts that you've shared around this conversation. We will be sharing follow-up resources with participants, which would include key insights from this discussion, a simple readiness reflection and prompt that you can use to look internally on how you can be ready for the corporate transition journey. So as the series continue and we go deeper into what credible transition readiness looks like in practice, we hope that you will be able to join us. The next series will be in the next quarter. We will share, but we will be looking at the people side. So people, we've talked about capital. People is also a very good part of the conversation. So we'll be having that. So thank you all for joining. We are at 11:32. Thanks. I would like to say thanks again to the panelists, to the moderator, and to the team, the UNGC team at the back end. I wish you all a beautiful Thursday and happy World Environment Day ahead. Thank you all.
Thank you all for joining us. I just had to come in and say thank you so much, Abraham, Daniel, and Samuel, for being a part of this conversation and for sharing such incredible insights. We really appreciate your presence today. Thank you.
Thank you.
Thank
Thank
you.
you all.
Thank you all.
Bye.
Bye.